Are you tired of always selecting the wrong order blocks? Then watch this video and you'll never struggle with order blocks again. Okay, so let's dive in. Let's start with the 3 biggest mistakes I see people make, and then we'll move on to the 5 principles that I use to successfully select my order blocks. Starting with number 1, the biggest mistake I see traders make is they pick order blocks that haven't taken an area of liquidity or don't have an area of liquidity target. Let's look at this example. We can very clearly see that price is in this downtrend, right? Consistently making lower lows, lower highs, and lower lows. Yes, we do break above this high, but as many of you know, we don't consider wicks as a breakup structure. That's simply just a liquidation. Now, let's take this trading range right here. We have a breakup structure down here. So we have a high and we have this low. Now, price breaks structure to the downside, which is amazing. That's one of the principles that we're going to cover later. And then most traders are looking at this and they're thinking that, this right here is their order block. And that is essentially what they're going to take for their trade. And they're going to try and short and take out the low down here. But the problem with this is that this area doesn't take any liquidity. And so it's simple: spot the liquidity or be the liquidity. What that means is if there isn't an area of liquidity for you to target before price tags into your order block, or if your order block hasn't managed to take a level of liquidity out, then it's likely that your order block is the liquidity. And that's because the market has one objective. It's to go and collect the orders in the market. So if you're not positioned in an area where orders are already being filtered out before they come and take yours, then your orders are going to be the ones that get used for liquidity. And so here's an example of an order block that does the opposite of that. If we look next, what actually happens? The price liquidates the highs, and then taps into this order block right here. So this is an order block example of where we have liquidity to target. That means that number 1, we've already taken an area of liquidity up here with this wick. And then we've pushed down, pushed back up, and then actually broken structure. So this is our trading range from this high right here to this low down here. That is our trading range. So any order block inside of that level is good as long as it fits the criteria. Now this one that has the liquidity set above it doesn't, because it hasn't taken liquidity. That's why it gets liquidated. Now this one, on the other hand, what does this have? This has liquidity just before it. So it's perfect because whilst it's tagging the orders, it's collecting orders at the same time. So it can tap into the liquidity pool, collect the orders, and then continue going to where it wants to go to, which is down because we are in a downtrend. So another example of this is taking order blocks that have just taken an area of liquidity. What does that mean? Well, look, we just break structure to the downside. So where is the order block that we could potentially be looking at? Well, we're looking at this final buy to sell range right here. Now what's different with this one is this range actually takes an area of liquidity before it breaks structure. It takes this area of liquidity right here. So this runs, takes the liquidity, and then breaks structure. Therefore, we already have taking an area of liquidity. And at the same time, what do we have? We have equal lows right down here. So these equal lows right down here are liquidity to target. So that is the first biggest mistake that I see traders make. They take their order blocks where there is no liquidity to take or no liquidity to target. And the way around that is using order blocks that already have taken areas of liquidity, or they have areas of liquidity just before them to fuel your move to the other side. Now let's take a look at the mistake number 2. Mistake number 2 that I consistently see traders make is they choose order blocks that have no relevance to current price action anymore. So they're just random. Let me show you what that means. So we're going to be using this level of supply right here, this supply order block right here as our example. Now what I want you to notice is, look, this is just where we've explained mistake number 1 that traders make. Now what happens after this? Well, price goes and breaks structure to the downside, break of structure down. Amazing. So now we have a new trading range. We have a high and we have a low. So you can be ready to get into the trade. Now, again, the same mistake we see traders make all the time is they're trying to get in this position right here. The issue with this position though is what? It doesn't take any liquidity, which means it is the liquidity. And where does then price go? Price goes to the order block that sat where? Above the liquidity. And so that would be the order block that you could be looking at. But we're not looking at that. We're looking at the next one. So what happens after that? Well, if we look, price actually breaks structure to the downside. So this is the new low, this is the new high. So most traders are looking at this and they're thinking, amazing, that's the order blocks that I'm going to be using. Why? Because, well, we've taken a level of liquidity. This order block is the order block that took that level of liquidity. We've broken structure. So why shouldn't I? Well, pay close attention, because what actually happens is price puts in a low, has a pullback, lower high, lower low, and then by the time price gets into this order block, what's happened? We've now shifted bullish. Price has actually shifted from creating lower lows, lower highs, and lower lows, and price has now put in a higher high. So this order block right now is irrelevant to current price action, because we're looking at an order block, a supply zone that wants to push price down, but actually we've shifted bullish. So then there's no doubt and no reason why that prices wouldn't run that order block. And so we tap in, we have some reaction because there probably are orders in there, but what's our goal? Our goal is to align ourselves with the institutional objective. And so if price has shifted bullish on the 1 hour time frame, then the institutional objective has just shifted long, not short. So most traders are getting trapped in this order block right here, while smart traders have shifted their objective bullish, which we're going to get into more detail when we break down the 5 principles of a successful order block. That is mistake number 2. Now let's move into mistake number 3. Now, finally, onto mistake number 3, which is more of a basic one, but it's still a very important one, and especially if you're new to supply and demand. It's taking supply and demand zones that don't break anything. You're basically just gambling, because supply and demand zones appear everywhere at all times. The key to trading supply and demand and order blocks is picking the right ones that make sense. So here are a few examples of picking random order blocks that make 0 sense. Here's one right here. Just because this is a nice looking buy to sell candle does not mean that we should use it for anything important. The same is then true again with this buy to sell candle. And then we have another one, another one, and another one. And now this is something you'll typically see most traders make the mistake of when they first get into supply and demand zone. They try to find supply and demand zones and they just try to trade them because they think that the key is the supply and demand zones, but it's not. The key is how you use the supply and demand zones. And so very simple lesson, but very effective. Your supply and demand zones must cause something. It must cause all 5 of the principles I'm about to share with you right now. Let's get into the 5 principles that I use when selecting my order blocks. And now, for what you've all been waiting for, my 5 principles on how to select successful order blocks. Pause this video right now, get a notebook and take notes, because what I'm sharing here, I've never shared for free before. Let's get into it. So, number 1, OB must take liquidity or have liquidity to take. We're going to be walking through a number of different scenarios, all in this one price leg that was from last month on GU, the pair that I trade, and we're going to look at how each one follows my criteria. Number 1, OB must take liquidity or have liquidity to take. Let's look at a bunch of these order blocks. Number 1, essentially OB right here, we have an area of liquidity to take. OB right here, we have already taken liquidity, right? Must take liquidity or have liquidity to take. Number 1, we have to take, and we've taken. Number 2, we've taken. right? Number 3 right here, we have to take. So number 1 is you must have liquidity to take, or it has already taken that area of liquidity. Number 2, it must break something significantly. What do I mean by that? What significantly? It must change character or break structure in the way that the trend is going. Meaning, if price is making a series of lower lows and lower highs, I only want to be getting involved in order blocks that are involved in the most recent leg that has just broke structure that first meets criteria number 1. So if we have some, say we have some, liquidity in here, most people are looking at this order block right here, but me, I'm looking at this liquidity, and I'm looking at this. For this 1 and 2, liquidity to take, break something significant. Then we move into number 3, which is OB is relevant to current price action. We don't want to be making and taking order blocks like this one. They're just not relevant to current price action. That's why it has to be in the most recent price leg. At all times, price has a current price leg, a range, right? Our trading range. Let's say price makes a series of lower lows, lower highs. This is what happens. Price has a low and it has a high. That is your current price range. Then price breaks out of that range, and what does it do? It creates a new range. Now you have a new, you have the same high and a new low. That's your trading range. Then price pulls back. I only want to be looking at order blocks inside of this price leg, inside of that trading range. Then when price comes back down and breaks structure again, we have a new high and a new low. And so what is it? For me, I only want to be looking at order blocks inside of this trading range. I don't want to be looking at order blocks up here. I don't want to be looking at order blocks all the way over here to the left. I want to be only focused on order blocks that are inside of this price range, because I'm expecting my structural understanding to play out. So I'm expecting this, and I'm going to be positioned inside of the order block that makes sense, that also applies to order block number 1. It also applies to order block number 2, because why? It's just broke something. This order block just broke this low. So it meets 1, 2, and finally 3. It must be relevant to the present moment. It must be relevant, because otherwise it doesn't make sense. It's just random. It may seem relevant, it may look like a good order block, but just like this looked like a good order block, what actually happened to it? It has a reaction, and then price just runs straight through it. Number 4, OB must have imbalance. Now, what is imbalance? Imbalance is super simple. If you take the first and the third of any candle range, if there's a gap inside of that candle, then that is essentially an imbalance. Let me show you exactly what that looks like. Let's say candle number 1 looks like this, right? Just for rough sake. Let's say candle number 1, if we can pull this to bring it to front. Okay, cool. Let's say that's candlestick number 1. And then let's say, this is candlestick number 2. And then we have candlestick number 3. And then price wicks to here. So here we have 3 candles, right? Now what you want to do is you go candlestick number 1 and candlestick number 3, sorry. Do candlestick number 3 and candlestick number 1 meet, right? These wicks should touch each other. If they don't, that is called imbalance. That simply means that a large portion of orders has just come into the market. What does that tell us? Institutions have just made their move. Because it's only institutions, it's only large amounts of money that can cause imbalance. So if we see imbalance, then we know exactly what just happened. And so that's why a price has to have imbalance. And if you look at all of them, we have imbalance, imbalance. We have on number 2, we have imbalance all the way in here, right? And even here, slightest bit of imbalance in there. Price must have an imbalance. And then finally, price must have a liquidity pool to target. Now I'm going to show you my favorite example, an example that we used for the community, and it's the most powerful example. So we're going to come and we're going to take all of our principles and we're going to apply it to this range of price action right here, right? So let's take a look and first mark out price action as though we were just marking out the charts. First and foremost, we always mark out structure. So we know we have a low right here, we have a high right here. I'm going to change back to purple. So we have a low right here, a high right here. Price break structure. Now we have a lower low. Price pulls back, lower high. Price break structure. We have a lower low. Price pulls back, lower high. We break structure. Price has a lower low. Price pulls back, liquidates. Key difference here. Price does not break structure or change character right here. Price liquidates because we consider that price must break and close above, not wick above. So price liquidates the highs, pulls back, and then closes and breaks above. So now we've had what we know as a change of character. The shift from market direction being one to being the other. Lower lows, lower high, lower low, lower high, lower low, higher high, change of character, pullback, break of structure, break of structure. So that is exactly what we've had right here. So now we've had our shift, change of character to the upside. So now price has changed character. We're now bullish. Great. So at this current moment in time, if we pull price back to here, at the current moment in time, price is bullish. So according to rule number 3, we only want to be looking for bullish order blocks because that's what relevant price action is. So we don't want to be still looking for bearish order blocks like this one. Even though it made sense earlier, it doesn't make sense anymore because it breaks rule number 3. So we need to be looking for bullish order blocks. Okay, so show me, we change character, where are our bullish order blocks? Well, our bullish order block is right here. This sell to buy that has huge momentum, that leaves behind imbalance, tells us what? Institutional money got involved in this area. Clear indication. Okay, cool. So we have an order block that meets rule number 3. Does it meet rule number 2? Does it break something significant? Well, yeah, it does. It breaks this high right here. This is even more significant than a normal break of structure because it's changed character. There has been enough buy in this area that has taken price from bearish to bullish. That is very significant, and we have broken that. So okay, we meet number 3, we can check that off. We meet number 2, we can check that off. Order block must take liquidity or have liquidity to take. Do we take liquidity? Yeah, damn right we do. What do we have right here, guys? What do we have right here? Trendline liquidity, exactly. Price makes a low, pushes up. Second bounce, pushes back up. Third bounce, where all the retail guys are taught to buy and then place their stop loss. What happens? Price dips down into the liquidity before reacting and then shifting to where it wants to go to. So price very clearly takes an area of liquidity. OB has imbalance. Number 4. Yes, very clear imbalance. A lot of momentum. Ticks that box. OB has a liquidity pool to target. An area of liquidity that price can then go to when it comes back here. Let's take a look. If we just zoom out a little bit, what do we see? Price has, for some while, been building this trendline liquidity. If we take this high right here, what have we done perfectly? 1, second touch, third touch. When everybody's taught to sell, what do we have? Perfect areas of liquidity. So OB has liquidity pool to target. Take your orders, stops below, target the areas of liquidity. Lo and behold, essentially allow price to play out. And that is essentially how you select the correct order blocks. Congratulations on making your way to the end of this video. That tells me that you are a serious trader, and we are looking for 5 new serious traders like yourself to join our mentorship program. Links are down below. Sign up today, and I'll see you hopefully on the inside.